Okay, we'll get better at these as we go.
Good afternoon. This is Joanne Toledo with RE/MAX Masters Millennium, and sitting down here today, I'm with Dana Smith at Fairway Mortgage, and we are going to do another episode of Mortgage Monday. And this is where we sit down and we talk about things that might be of interest if you're going to buy or refinance, but what's going on in real estate and mortgages.
Yes.
So today, I thought this was a great topic. Actually, it wasn't our topic. We had some folks that emailed in and had questions. So some of these myths, and we're gonna dispel some myths, and we're gonna talk about a few things, credit questions, purchasing, but yeah, just a few questions here. So great, we'll get started. So Dana.
Yes.
Question number one, credit. What's the minimum credit score to purchase a home?
For FHA and VA, the minimum score is a 580, and that is to purchase. You can do a streamlined refinance, and we don't have to have a credit score. So for FHA streamlines, no credit score needed. For conventional, you really do need to be at a 620. We do look at extenuating circumstances. We look at the whys. I just closed one not too long ago that their score was under 620, but he was able to show us that medically he had significant issues. And we all know medical collections get put on credit all the time, and half the time they're not true collections. Right. So we do look at the why before we just look at the number.
And that affects your interest rate, of course.
Mm-hmm. The lower the score, the higher the interest rate is going to be. So you want to put yourself in the best position to get a better interest rate.
But you can purchase it with a 580.
You can purchase it with a 580.
Okay. Next question that came in was, how long after bankruptcy, short sale, or foreclosure can I buy a home?
Typically, it's 4 years. Again, we look at reasons for the bankruptcy, and if it was medical, medical's a big thing. If it was substantial medical, then, and that most of the debt that was included in the bankruptcy was medical, we actually can do it in 2 years. Foreclosure and short sale, those have to be extenuating circumstance. A divorce is not an extenuating circumstance, but I did have one borrower that her husband had passed away, and unexpectedly. And because of that, we did go ahead and make an exception.
Right.
Due to the extenuating circumstance, and we allowed her to purchase a home much sooner than that.
Okay, so if it makes sense, it can work.
Mm-hmm.
Yeah, perfect. Next question. What about these credit repair companies that are out there? Are they worth the money? And does it work?
So credit repair companies, I always struggle with somebody paying $200 a month or a monthly fee of any kind, when that goes to doing something that, one, I do for free. Fairway has their own credit repair company, and we don't charge because I'd rather them take that $100 a month and pay down debt, which is going to end up being a lot better improvement to your score than getting a collection that was 3 years ago off, which really has very little impact on your score. Mm-hmm. There's a few good debt repair companies or credit repair companies, but I would do your homework for sure.
Okay.
Before you get into it.
But you said that Fairway has one.
We have our own.
They can contact you for that information?
Yes, that's one thing I am known for is I can fix credit, I can advise, I can put you on a path so that you know where you want to be. I can tell you if in 3 months or 6 months you can purchase something if you follow the steps. Okay. And that's free.
Perfect. Next question, kind of along those lines, but so there were some people that were curious about the debt consolidation companies, and I've heard on the radio, and you hear all this, but how they can save you, and I guess depending on your certain situation, but how does a debt consolidation program look on your credit?
It is the same thing as a Chapter 13 bankruptcy, basically, and that is you owe the money, whether it's the bankruptcy courts or through the debt consolidation. Right. They basically offer pennies on the dollar, and so it is looked at just as a Chapter 13 bankruptcy.
Okay,
So not good.
so it doesn't look good.
It doesn't look good.
Okay.
If you're wanting to pay less than what you agreed to pay, that's not good. If you're wanting to, just because you have too many bills outgoing and you want to consolidate, there's loans out there to help consolidate it into one. That's fine. It's the true consolidation
Okay.
programs that are not good.
Do you find that people aren't aware that that looks bad on their credit?
100%. I just had somebody try and buy a new home. He had no idea. He's been in it for a year, never been late to them. But again, we look at it, every lender has to. Credit union, everybody has to look at that as a Chapter 13.
So they just don't know that?
They just don't know that. And they're not going to tell you they want your
Of
money.
course not.
Yeah. So you don't
Right.
find out until you go and think your score is high enough to buy a home,
And then
that comes through.
Okay. All right, our last question is a good one. I hear this one myself. Is it better to pay off debts and have less money for me to put down, or is it better for me to have more debts and a larger down payment? So we're going to weigh, and this is where it's great to talk to you, and we get a plan going with this person who's looking, because they really do want to know, what shall I do? Pay my debt off or have a bigger down payment?
So with rates being in the threes right now, and you've got credit cards that are 13, 18, 24%, obviously it would be better to put more money to paying off the debts than putting it onto the loan. Because for every $1,000 that you put on a loan, it only changes your payments by about $5. Whereas you can substantially decrease your debt and increase your credit score the lower your credit card balances are. So for a loan side, I think it's better to have less debt, less down payment. When it comes to negotiating a contract, then that's
a tricky one. So you and I might disagree on that particular point, but when it's this type of a market and we are in a multiple offer situation, we do look at down payment and we look at additional earnest money, maybe the strength of the buyer really. But that being said, then I put my buyer agent hat on, and I tell them put as little down, because it's super hard to save money. So leave it there, only use as much as you need to. So,
and in this market, CPAs and financial advisors are also telling customers, even if you have 20% down, sometimes they're saying, don't put it all down. And with rates the way they are, it's cheap money.
Sure. All right, that's all we have today.
All right,
Thanks
thank
so
you.
much. See you next Monday.
Have a great day.